On January 1, 2025, the People's Republic of China made a move that many geopolitical analysts had feared for years. They officially placed silver under state trading export controls. The message from Beijing to the global market was unambiguous. Our silver is now a strategic national asset. We are locking down the supply. The immediate reaction was predictable panic. Industrial manufacturers, particularly in the West, scrambled to secure inventory. Analysts predicted severe shortages. The price of silver began a relentless climb. It seemed clear that China, the world's largest consumer of silver, was preparing to hoard every ounce for its massive domestic solar and electronics industries. But then, in October 2025, just 9 months later, China did the unthinkable. They didn't just tweak the policy, they completely reversed it. In a single month, China exported a staggering 660 tons of silver. That is the largest monthly export volume on record. And it went straight to London, the very heart of the Western financial system they were supposedly cutting off. This wasn't a gradual policy shift. This was an emergency dump, a massive injection of physical metal designed to flood the market and break the upward price momentum. And here is the anomaly that defies basic economics. It failed spectacularly. Despite flooding the market with 660 tons, roughly $37 billion worth of metal at the time, silver didn't crash. It didn't even slow down. Instead, it accelerated, hitting an all-time high of $66.21 in December. So, what is really happening? Why did a superpower reverse a strategic resource policy in a blind panic? And why did the market completely absorb a record-breaking supply dump and keep screaming higher? The answer lies in data that Beijing tried to hide and a structural crisis that can no longer be contained. To understand the panic behind the October dump, we must look at the data from the Shanghai Futures Exchange. This is the barometer of China's domestic industrial supply, and the readings are catastrophic. Let's rewind to January 2021. Shanghai warehouses held a healthy 3,911 tons of silver. It was a comfortable buffer, but watch what happens over the next 4 years. As China's solar production ramped up exponentially, that stockpile began to evaporate. By December 2025, that inventory had collapsed to just 780 tons. That is a 75% wipeout of visible silver stocks in less than 5 years. This is critical to understand. China wasn't restricting exports in January to build reserves. They were restricting exports because they were running out. The math is brutal and inescapable. In 2024, China's mines produced roughly 3,300 tons of silver. Yet their industrial machine consumed 19,000 tons. That is a domestic deficit of 15,700 tons every single year. For years, they filled this gap by importing heavily and draining their existing stockpiles. But by late 2025, the stockpiles were gone. The January export ban was a desperate attempt to keep domestic silver inside China to feed the solar factories. So why lift the ban in October? Why export 660 tons when you are already starving for metal? Because a greater crisis emerged, one that threatened the plumbing of the entire global financial system. Here is what happened behind closed doors in the weeks leading up to the October dump. The London Bullion Market Association, the hub of global precious metals trading, was experiencing a severe physical squeeze. While paper contracts for silver were trading in the $40 range, major industrial buyers attempting to take actual delivery of the metal were being told there was none available at that price. Inventories in London were dangerously low. The desperation was so high that buyers in London started offering massive premiums over the spot price just to secure physical metal. Normally, silver flows into China because Shanghai trades at a premium. But in October, the London premium became so violent that it reversed the flow of global trade. The arbitrage became irresistible, or more accurately, necessary, to prevent a complete market breakdown in the West. China became the supplier of last resort. They had to raid their already depleted Shanghai stockpiles to bail out London. This reveals the mechanism driving this market. It is not a cycle, it is a death spiral. It moves in 6 stages. Stage 1, China imports heavily to feed its industry. Stage 2, the domestic solar boom consumes stockpiles faster than imports arrive. Stage 3, Shanghai inventories collapse 75%, triggering the January export ban. Stage 4, the ban starves the rest of the world, causing a physical squeeze in London. Stage 5, China is forced to lift the ban and export emergency supply to save the global pricing mechanism. And finally, Stage 6, prices continue rising anyway, because the underlying structural deficit has not changed. And it wasn't just London. While China was bleeding inventory, India went on an unprecedented buying spree, importing over 2,600 tons in just 2 months in late 2025. Much of this metal was routed through Western markets, further draining supply. China didn't reverse policy to help the West. They reversed it because global industrial demand created a vacuum that threatened to implode the system if they didn't feed it. The most terrifying aspect of the October event for short sellers was this. Why didn't a massive record-breaking injection of 660 tons crash the price? The answer changes this from a financial story to a physics story. You cannot easily substitute silver. Silver has the highest electrical conductivity of any metal on the periodic table. Period. Physics doesn't negotiate. In high-stakes industrial applications, good enough isn't acceptable. Look at the solar industry. In 2025, the industry shifted aggressively to new, higher-efficiency panel types called TOPCon and HJT. These new panels are far more efficient, but they require 50 to 80% more silver per unit than older technology. The 660 tons China dumped wasn't absorbed by speculators. It was inhaled by solar manufacturers who are terrified of production line stoppages. Then there is the new giant in the room, artificial intelligence. The massive data centers powering the AI revolution require connectors and components that can handle immense electrical loads without overheating. You can't use aluminum. The resistance is too high. You must use silver. The demand is non-negotiable. Industry needs silver to function, and the supply is finite. That's why the dump failed. The market didn't see supply, it saw necessary fuel that was immediately burned up. This structural deficit is now colliding with geopolitics. In 2025, the U.S. Geological Survey officially added silver to its critical minerals list. This isn't just paperwork. It enables the U.S. government to use national security authorities to secure supply, potentially including tariffs or strategic stockpiling. If trade tensions worsen, silver becomes a weapon. But ultimately, this comes down to cold, hard math. Let's do the calculation that terrified Beijing into the October dump. As of December, China's remaining visible Shanghai stockpile is 780 tons. Their domestic industry consumes roughly 19,000 tons a year. That breaks down to about 1,580 tons per month. If you do the division, that leaves less than 14 days of visible supply cover for China's domestic industry. Even if we assume they have hidden off-exchange strategic reserves, and they almost certainly do, we are talking about a timeline of months, not years, before total exhaustion. China's October dump was supposed to calm the market. It was supposed to prove that supply was adequate and scare off the bulls. It failed completely. You cannot dump your way out of a structural geological deficit. You cannot policy your way out of the laws of physics. The illusion of abundance, maintained for years by paper trading and inventory drawdowns, has been shattered. The scarcity is the reality. The system is changing, and the transfer of wealth has already begun. The question isn't if it happens, but where you will be standing when the stockpiles officially hit zero. Don't rely on luck. Rely on history. This is InvestEdge. Subscribe to see what the data reveals next.